The Power of the Other 493, a deep dive into the Invesco S&P 500 Equal Weight ETF, RSP. As of February 9, 2026, the stock market has reached a critical turning point. For the last several years, the Magnificent Seven, the tech titans like Nvidia, Apple, and Microsoft, driven by the artificial intelligence revolution, have essentially been the market. When most people talk about the S&P 500, they think they are buying a broad cross-section of American industry. In reality, they have been buying a high concentration bet on a handful of Silicon Valley giants. This is where the Invesco S&P 500 Equal Weight ETF, ticker RSP, comes into play. In early 2026, as market breadth has finally begun to widen and investors seek protection from a potential AI bubble pop, RSP has moved from a niche alternative to a central strategy for millions of investors. This guide breaks down everything you need to know about RSP, from its unique mechanical structure to why it might be the most important safety net in your portfolio today. 1. The mechanic: market cap weighting versus equal weighting. To understand RSP, you first have to understand the hidden flaw in traditional index funds like the Vanguard S&P 500 ETF, VOO, or the Spider S&P 500 ETF, SPY. The market cap trap. Most index funds are market cap weighting. This means the bigger a company's market value, the more of your money goes into it. If Apple represents 7% of the total value of the 500 largest companies, then $7 of every $100 you invest goes to Apple. By late 2025, the top 10 companies in the S&P 500 accounted for more than 35% of the entire index. This is the highest concentration in nearly 50 years. The RSP Solution. RSP takes those same 500 companies and ignores their size. It gives every company an equal seat at the table. The math: each of the 500 stocks is assigned a weight of approximately 0.20%. The equality: in RSP, a massive company like Microsoft has the exact same influence on your portfolio as a smaller S&P 500 member like Ralph Lauren or Southwest Airlines. The other 493. While traditional funds are dominated by the top 7, RSP is driven by the performance of the remaining 493 stocks that often get ignored during tech-led rallies. 2. The power of rebalancing, a built-in buy low, sell high machine. One of the most misunderstood aspects of RSP is its quarterly rebalancing. This is the secret sauce that historically has allowed equal weighting to outperform over very long periods. Every 3 months, March, June, September, and December, the fund resets its weights. Imagine that over 3 months, Nvidia's stock price skyrockets by 50%. In your RSP portfolio, Nvidia's weight might have grown from 0.20% to 0.30%. Conversely, imagine a utility company like Duke Energy fell by 10%, and its weight dropped to 0.18%. What the rebalance does: sells the winners. To get Nvidia back down to 0.20%, the fund automatically sells off the excess 0.1%. Buys the losers. It takes that profit and buys more of the underperforming stocks like Duke Energy to bring them back up to 0.20%. This is systematic mean reversion. In a traditional cap-weighted fund, as a stock gets more expensive, the fund buys more of it. RSP does the opposite. It locks in profits from winners and reinvests in companies that are currently on sale. 3. The 2026 context: breaking the AI fever. Why are investors flocking to RSP in early 2026? It's because the AI premium has become expensive. As of February 2026, the S&P 500 market cap is trading at a price-to-earnings PE ratio of roughly 24.1x. Meanwhile, the equal-weighted version, RSP, is trading at a more reasonable 17.9x. Broadening market participation. In January 2026, the S&P 500 rose by about 1.4%. However, RSP rose by 3.4% in that same month. This is a massive outperformance. It tells us that while the giant tech stocks were stagnant or falling, the rest of the economy, industrials, financials, and energy, was surging. By owning RSP, you aren't betting against tech. You are betting that the rest of the American economy is finally ready to catch up. If you believe that the AI revolution will eventually help regular companies like manufacturers and retailers become more efficient and profitable, RSP is the best way to capture that secondary wave of growth. 4. Sector diversification, a different shade of equity. When you buy RSP, you are dramatically changing your sector exposure. The S&P 500 is currently a tech and communications index in disguise. Sector shifts: RSP versus SPY. Technology. In a cap-weighted fund, technology is roughly 32 to 34%. In RSP, it is only 15.5%. Industrials and financials. These sectors are the heavyweights in RSP, each making up about 14 to 15% of the fund. Defensive plays. RSP overweight sectors like utilities and real estate compared to traditional funds. This makes RSP much more resilient to tech wrecks. If a regulatory crackdown hits the big social media or chip companies, a traditional index fund would crater. RSP, however, would likely stay afloat because its fortunes are tied to the banks, the power plants, and the factories that make up the backbone of the country. 5. The size factor tilt. In the world of professional investing, there is a theory that smaller companies tend to outperform larger companies over very long time horizons. This is known as the size factor. Because RSP treats a $20 billion company the same as a $3 trillion company, the fund has a significant tilt toward what we call mid-cap stocks. Most S&P 500 members aren't actually mega-cap giants. They are successful mid-size firms. By giving these mid-caps an equal 0.20% weight, RSP captures the explosive growth potential of smaller firms that are lost in the shuffle in a market cap fund. Over the last 20 years, this size tilt has been a major reason why RSP has often outperformed the standard S&P 500 during periods of economic expansion. 5. Fees, friction, and the expense ratio. There is no such thing as a free lunch in finance. Because RSP has to trade stocks every 3 months to rebalance back to equal weight, it costs more to run than a passive fund that just holds stocks forever. The cost of maintenance. RSP expense ratio, 0.20%. This means you pay $20 per year for every $10,000 invested. SPY VOO expense ratio, 0.03% to 0.09%. These are rock bottom cheap. Is it worth the extra $17? In 2026, most advisors argue that it is. While you pay a slightly higher fee, you are paying for the rebalancing service. To manually rebalance 500 stocks yourself would cost thousands in commissions and take hundreds of hours. RSP provides a smart beta strategy for a very small premium. 7. Critical risks. When does RSP underperform? You should not put 100% of your money into RSP without understanding its kryptonite. RSP has specific periods where it looks like a bad investment. The mega cap melt-up. If the top 5 companies in the world are the only ones growing, as seen in late 2023 and early 2024, RSP will lag behind. You are effectively punishing your winners by selling them every quarter. Higher volatility. Because RSP is more exposed to smaller, mid-cap companies, it tends to be slightly more volatile. In a sudden market panic, these smaller firms can drop faster than fortress companies like Apple or Berkshire Hathaway. Deeper drawdowns. Historically, in major crashes like 2008 or the 2020 COVID crash, RSP fell slightly more than the market cap S&P 500 because investors rushed to the safety of the biggest, most cash-rich giants. 8. Strategy. How to use RSP in 2026. For a new investor in 2026, the best way to think about RSP as a core diversifier. The 50-50 split. Many balanced investors are moving towards a 50% VOO, market cap, and 50% RSP, equal weight strategy. This gives you exposure to the incredible innovation of the tech giants while ensuring that you aren't all in on just 7 stocks. The reversion play. If you feel that the stock market has become too concentrated and too top-heavy, you might tilt more heavily toward RSP, say 70% of your large cap exposure, to wait for the rest of the market to catch up. Dollar cost averaging. Because RSP rebalances for you, it is an excellent fund for monthly automated investing. You are essentially letting a computer buy the dip for you every 3 months across 500 different companies. Conclusion. The return of the other stock. Investing in the Invesco S&P 500 Equal Weight ETF, RSP, is a vote for the entire American economy, not just its loudest and largest players. In the complex landscape of early 2026, with AI valuations high and interest rates stabilizing, RSP offers a rational, disciplined, and diversified alternative to the standard index fund. It removes the ego of the market, size, and replaces it with the logic of the economy, equality. The verdict. If you are worried about putting all your eggs in one tech basket but still want the safety of the 500 largest U.S. companies, RSP is your premier tool for 2026.